afternoon, ladies and gentlemen, and welcome to the latest installment of the Option Industry Council's webinar series. My name is Mark Benzequin, and I'm a staff member here at the OIC. We're glad that you can join us to learn more about options as a flexible and powerful trading tool. And in today's presentation, Choosing an Option Strategy Using Behavioral Japanese Candlestick Trading, we'll learn new ways to build your option strategy using a unique and simplified process. Additionally, our previous webinars can be viewed on both our optionseducation.org website and our OIC YouTube channel. That being said, ladies and gentlemen, I'd like to introduce you to our presenter today, Mr. Dan Gramza. Dan is president of Gramza Capital Management and is also an international speaker and frequent TV commentator. Dan is famous for his works and insights into implementing Japanese candlesticks into a strategy selection, and we here at the OIC are lucky to have him with us today. And though we have a lot of information before we begin, I want to cover just a few basics and do a little housekeeping, as I'm sure you're familiar. The OIC is an industry resource fully funded by the OIC as well as the local option exchanges throughout the country. Our sole product that we sell, our only agenda, is to provide options education to individual investors as well as financial advisors and brokers throughout the world. The OIC, our parent company, is the world's largest equity derivatives clearing organization and the foundation for secured markets. As I said, OIC is funded by the OCC as well as the various option exchanges. Now, some time ago, those exchanges numbered in the double figures, about 14 or 15 to my recollection. However, with the recent buyouts and mergers and consolidations of the industry, we're left with about 5. The CBOE here in Chicago, the Boston Exchange, which is known as the BOX, the MIAX Exchange in Miami, and then we also have the NASDAQ and the NYSE. In terms of options volume, if you are a frequent OIC webinar attendee, you're very familiar with the slide, and one of the reasons that we like it so much is it shows you at the beginning of the industry, back in the early 70s, you can see, options were in their infancy and not much trading. Really, in the early 2000s, with the advent of electronic trading as well as ETFs, you can see how options growth really exploded exponentially. As a matter of fact, in 2016, I believe the OCC cleared about 4.6 billion option contracts. We're averaging about 16 to 17 million option contracts a day, which is really an extraordinary number. Now, again, some disclaimers that we need to cover. Options involve risks and are not suitable for everyone. As a matter of fact, to trade options, you'll need to have your portfolio account approved by your broker. Your broker will make sure that you have a copy of the Characteristics and Risks of Standardized Options brochure. You can also get a copy from the OCC. Dan will be talking about many different strategies, and for the sake of simplicity, the examples that we're going to be using do not take into consideration real-world factors such as commissions and transaction fees and taxes, etc. As well, the strategies that Dan discusses, including examples, are simply for illustrative and educational purposes only. They also are the ideas of the presenter and do not reflect the Options Industry Council or the OCC. Now, that being said, I'd like to turn it over to Dan. He does have a wealth of information to share with us, so let's go ahead and jump right in. Dan?
Great. Thank you very much, Mark. Hello, everyone. I'm really excited about exploring some of these ideas with you today. As you can see here, the topic that we're going to be looking at, behavioral. We have candlestick here, but actually I call them candles. We're going to be looking at Japanese candles and how we can implement those or as another tool to help us make a decision about the markets and strategies we may want to consider. But before we do that, I also want to mention to you that I'm not affiliated with the OCC or the OIC. And again, just as Mark said, they're not endorsing anything I'm going to share with you. These are ideas that I hope you find helpful. They've helped me, and I hope they help you. Also, I just want to mention I do a free daily commentary, just more on general markets and movements. It's at dangramza.com. And the intent there is just to give you an idea of how someone approaches the markets and analyzes the markets. It's going to be using some of the techniques that I use there that we're going to be using today as we go through these various market strategies. Well, just a few things I'd like to review, and I'm sure you're sensitive to these thoughts, but why do people trade options? And I think there's 4 categories. One, they may have an opinion about price direction. They may have an idea about volatility, that they expect it to increase or decrease. Or it may be mispricing between options, or mispricing between the options and the underlying stock. I deal with some firms here, actually in Chicago, that their whole focus is in that area, the last 2 areas, mispricing between options and the underlying stock as well. And so they look at what should it be, where is it undervalued, overvalued, and it helps determine the types of strategies that they're going to use. Now, for you and me, we're going to focus on this first one, really, and the second one, too. Those 2 are kind of intertwined with what we're going to be looking at. But it's price direction. And, the thing that always fascinated me when I should give you a little bit of my background is I started with stock options, actually, and delta neutral spreads. And basically, I started thinking about price again because I realized when I did the delta neutral spreads, I didn't have to worry about price, but I did have to worry about that new variable, volatility. So I decided to look back at price, and I wanted to look at price direction. Well, the guys across the street at the CBOT, I should say, they traded futures and they looked at price movement. So that's what we're going to be doing today. We're going to look at price movement. If you look at most things about options, they begin with, if you think the market's going up, down, or sideways, here's what you do. Well, how do we make that decision about price direction? And what we're going to look at today is just one idea, one sliver of information that you and I could look at to help us determine that. And that's what I want to share with you. I also believe when it comes to a directional strategy, because that's what we're going to be talking about today, right? We're going to talk about a bias, a price direction bias. And what I find is common mistakes when it comes to looking at a directional play with options. It's oftentimes people really don't have a directional bias. They're doing it not because they see something that gives them a clue about price behavior. They're just doing it because it feels that way in their gut. And that is one approach. Or I think options oftentimes, out of the money options, get abused. They're buying an option for $50 because the price is right. But that option may have a delta of 5. And as you and I know, if that stock moves up $1, this may move up 5 cents. And so they say, gee, these options don't work. Well, if you and I take a close look at what they're doing, the option's doing exactly what it should do, and it's not going to move $1 if the delta on that option's at 5. Well, so I think out-of-the-money options can get abused. The other one is too tight of an expiration. Oftentimes what I see is that someone's saying, well, I had the right idea, but this thing's going to expire on me. And there are challenges to that I personally don't want to deal with. I don't want to, if I'm long options, I don't want to deal with theta. I don't want to have to deal with that time decay. If I'm selling options, that's my friend, and I don't mind it at all. But we're talking about here, if I'm going to be buying an option, the idea of too tight of an expiration, I think, is a common problem, where the trade doesn't have a chance really to mature because of their expiration selection. Also, buying options with high implied volatility. In other words, they're buying the expensive ones, whether it's a put or a call. or some other type of strategy. We want implied volatility options depending on what we want to do. Those are usually the ones we want to sell because that premium's built up, right? It's pumped up with that implied volatility. If we're on the buy side, we want to buy something that's cheap, that's less expensive. And that's one of the guidelines we're going to be using, and it's a part of the strategy that we're going to be talking about. And I think the other one is overstaying a non-performing trade. If the trade's not performing, or someone says to me, well, I paid $500 for this option, and, well, who knows? Maybe this thing could go. I'll just give it a little bit more time. Well, just a little bit more time can be very expensive. And what goes through my mind when I hear someone saying that is that they're saying to me they have a trade on that isn't performing, isn't working. They're now in a hope trade, and they're planning on making a $500 donation to the market. So I think it's important for any strategy that you and I look at that we think about time around that strategy. For any of you who look at maybe some technical approach regarding price, so it could be moving averages or oscillators, there's a whole variety of techniques that you and I could use to help guide a price decision. But if you look at those, most of those trades that perform are probably going to happen within 2 to 5 periods of time. Think about any trade that you've done and you go, that was a good trade. So whatever trade you would classify as a good trade, think about when it started to be productive. And chances are, right after your signal, within that 2 to 5 period window, it started to be productive. So I think it's an important parameter that you and I want to be aware of when it comes to establishing a directional type strategy. So what I'm going to propose is that we're going to be looking at a directional position with a specified directional bias. Because of the tool that we're going to look at, it implies certain price behavior to occur. And so that's going to be the initial guiding light. We're going to be doing or looking at a possible strategy because we have some guidance to that conclusion. We're also going to be looking at the money or deep in the money options. I want delta near 100. The reason is that if I'm going to make a trade, and if I don't have confidence in the trade to move like the underlying stock, well, I shouldn't be doing the trade. I'm not interested in doing a hope trade. I'm interested in defining our parameters. And so if indeed this trade's going to work, well, I want bang for the buck. I want that delta near 100 so that when that stock moves $1, my position moves $1. So I could do 2 at-the-moneys or near at-the-money options or a deep in-the-money option to give me that kind of impact. So that's the type of option that I'm considering. Also, expiration beyond the current. If I'm looking at a daily chart, that's what I'd want. If I was looking at a weekly chart, I may look at 2 expirations beyond the current, provided that there's the volume there to support our trade. I don't want theta to be an issue for me. And I want, if this trade is established and it does start to perform, I want to give it some time so that it can perform before theta becomes a part of that whole option position that I'm dealing with. So expiration beyond the current. Also, buying options with low implied volatility. Now, that would imply that I'm going against the direction of the trend. And in some cases, it may be the case. Or it could be a profit-taking move of an uptrend or a downtrend that we're now establishing a position. But typically, we're going to be looking at options that have a low implied volatility. And then also, we're going to be using time and price to regulate that trade. So from my point of view, if we have the right kind of setup, And if this trade doesn't perform in a particular amount of time, I'd just soon give it the big adios, take that money, and put it someplace else. Look for another trade that's setting up that way. There's so many times a trader can get married to a position, very easily actually, because they have this high expectation, or if they've made money before in that particular stock or those options on that stock, they have a tendency to have that same expectation for the future. My feeling is every trade stands alone, and I have certain expectations for it. If it doesn't meet those expectations, I just soon get out, take that money that's left, and put it to use someplace else. So we're going to be looking at time and price, and what I thought we could do today is look at something specific. These parameters that you and I are going through. I believe that they apply to any technical approach. So whatever technical approach you're using now, you might want to think about your option strategy based upon some of these parameters. So whether it's two moving averages crossing over, or a stochastics below 30, and now you're looking for a buying opportunity, or a market profile chart that gives you a clue about value that you're going to lean against. There's a whole, again, plethora of tools that we can use. And today, the guiding principles that we're going to be using today are what I'm going to show you right here, what I've just showed you. But think about them not just with what I'm going to show you, but with any technical approach that you use. Now, let's talk about these candles. This is a tool that I saw in Japan at Bank of America. It was in the Treasury Department at Bank of America. I was there to teach a course to clients of the bank, other banks basically, on yield curve trading, and I was using market profile as a tool. Part of the class was to go into the dealing room and to identify trades in U.S. Treasuries and then go back into the classroom. So I went into the dealing room, found some trades, we put those trades on. I'm walking out and I see a gentleman drawing at a big piece of paper, drawing this candle chart. And he had candles on the top, and then he had right below him, he had some other candles. And what they were the 30-year Treasury bonds, and he had a daily chart on top and a weekly chart on bottom. And he's drawing them freehand, and they're like little works of art. Amazing to me. So I said to the gentleman I was with, I said, Kuno-san, what are these? And he said, oh, these are Japanese candle charts. Now, what went through my mind is what I want to share with you now. And when they were talking to me about various patterns and things like that, what I kept thinking about is what would that sound like? What would that look like on the floor? Because my background to these trading ideas come from a floor perspective. So if you and I were standing on the SIBO floor, or if we were standing over at the board of trade on the floor, it really didn't matter. If we saw the broker's hands showing a size, and we can see that action occurring at a certain price, so we know there are certain behaviors that were triggered at that price level. And what happened to me personally is I was watching the broker's hands. I was looking at a chart. This is between bond and bond options. And at first, I didn't see any connection. But when I started really focusing on the broker's hands, I did see a connection. That when they were doing certain things, oh my gosh, we would see it reflected in that candle chart. And it's that observation that, one, I was very interested in leaving the floor at that moment. And second, I'd like to share with you now. Now, for those of you familiar with Japanese candle charts, here's what I'd like you to do. Please put those ideas aside while we're going to go through this. Because for those of you who are not familiar with this, the standard approach would be that you and I would talk about candle patterns, which are the relationship between candles. And there's about 80 patterns that you and I could go through. The challenge I find when I would teach those 80 patterns is who remembers number 1 by the time you get to number 80? Which ones are important? How do you trade them? Nothing wrong with that approach, by the way. Nothing wrong with it at all. But from my point of view, I think those ideas can be simplified to about 8 concepts. And today we're going to be looking at some of those concepts. So I want you to think about it in terms of behavior. And by behavior, I mean the buying and selling forces that come into a market that creates price movement. And I call these candles, by the way, because that's the way it was taught to me. And a candlestick is actually what you put a candle in. These shapes that we're looking at are candle-like shapes. It's a very small detail, not a big deal, but I thought I'd just explain that. Now, what they do is they draw a box between the open and close. And if the closing price is above the opening price, I have this box as green. The traditional color, by the way, if you go to Asia, it's still used that way, would be red. Because red's, a positive color in that part of the world. It signifies a lot of positive things. But I have that as green. And what it means is, and whatever color you define it as isn't so much the issue, as long as you understand that relationship. But the closing price is above the opening price. No, that's also called the body of the candle. I think it represents buyers coming into the market. Now, why? What is it that drives that body to create that shape that I would think of it as buying? Well, if you look at the opening price, let's look at the bottom of that candle. And let's imagine that it's opening at 50. And you and I are on the floor, and we're bidding for this market. You're a broker, I'm a broker. You're trying to buy 100, I'm trying to buy 100. And the market's trading at 50. Well, to get that done, to get that order filled, what we would do is we're competing against each other. And maybe I raise my bid to 51 and I get filled. And then you raise your bid to 52, you get filled. And so as the order comes into the market that day, most of it happens to be to the buy side. And you can see the market goes up and it goes down, and it goes up and it comes down. It moves back and forth as the day progresses, because there's some times where more selling orders come in and the market gets pressed down a little bit by those sellers competing against each other. And buyers, after that's done, or maybe buyers take a little profit, the market starts moving back up again. And at the closing price, it closed at 60. Why did it close at 60? From my point of view, because there was an imbalance of buying order flow throughout that session, throughout that period of time. More people wanted to buy it than sell it. And by the way, what I'm talking about here are the orders that come into a market. Oftentimes, the other side of that order would be a market maker, or is a market maker. And that market maker, their agenda is they're in and out as fast as they can be. They're there to provide liquidity. They'll take the other side of our trade. So if you and I want to buy, they will sell it to us. If you and I want to sell, they will buy it from us. That's the bid and offer that you and I see for an option. That represents that difference that a market maker tries to make. But they're in and out in a flash. Their ability to cause a long-term trend, I don't think they do at all. What causes that long-term trend is us, the people who are still holding that position, who are not in and out in a flash like a market maker. So I believe that this market, that candle that you're looking at, represents buyers coming into the market. Now, on the other side, when we see the closing price below the open, I think just the opposite happens, and it's a result of sellers competing against each other. And that drives prices lower. And here I have the high matches the top of the candle and the low matches the bottom. And as many of you know, that doesn't always happen that way. Sometimes the high price is above the body of the candle. That's represented by a vertical line called a shadow. And I think that represents sellers at higher prices. And when the low doesn't match the body of the candle, that difference is a vertical line, again, called a shadow, but I think that represents buyers coming into the market. Now, here's what I want you to think about. From that closing price, let's say the green candle, from that closing price, as it moved higher to the high price, you can imagine that, that would have been a green candle all the way up to the high. At the moment it traded at the high price, the green body extended to the high. But something happened at that price. At that level, for whatever reason, the market started trading down from that high price, and we would have seen a shadow starting to be formed. And the reason it started coming down, I believe, is that sellers are now coming into the market, and they're driving prices lower. And then it ended up closing above the opening price, which is why it's still a green candle. Now, let's add a few other pieces to this. I call these behavioral candle characteristics. And let's say that you and I see this green candle, and that you and I are long this market. It could be the options, it could be the stock, or it could be a stock that we're monitoring to establish an option trade. But right now we're seeing buyers coming into the market. Now, let's say we're long this market. The next 2 to 5 periods, I believe, would tell us how to manage that position. And over the next few periods, you and I see this kind of behavior. Now, if we go along with a few other premises, let's talk about that. What does that behavior represent? Well, I think the size of the body represents commitment. It represents enthusiasm. It represents the ability of the market to want to participate. So at the very last box that you see at the top, were the buyers, if we agree that this represents buying, were the buyers as enthusiastic as they were at the very first candle? And you and I would say, well, no, because if they were, the last body that we see in these candles at the top would have been as big as the one at the beginning. It's not. So what we know is that there's a lack of momentum. There's a loss of momentum as the prices moved higher. That we're seeing less and less buyers committing to this position. So that implies the market may be getting weaker. And let's say that we were trailing our stop below the lows of those green candles. You know, it'd give us a clue that something's changing. Does it mean it's going to go down? We don't know that. What we do know is that the current price level, the behavior at that level is not the same as it was 5 periods ago. So again, the next 2 to 5 periods tell us what to do. I believe here it tells us be cautious. And let's say that now because of this loss of momentum, that we do decide to sell it if it trades lower. And here it did. Again, the same issues. The next 2 to 5 periods tell us how to manage that position. And again, we're seeing bodies getting smaller. We're seeing a change in behavior. In fact, let's add some shadows on here. How does that change the picture? Well, let's say the very top candle there. Let's imagine that you're in the office, I'm not, and I give you a call and I say, hey, what's going on? I'm not at a screen. And you say, well, today, this last top green candle, it made a higher high than the previous candle, and it made a higher low than the previous low, and it's closing higher than the previous candle, previous day. And I say, wow, higher high, higher low, higher close. Ooh, I'm really bullish this market. I think I should buy more. Now think about what you would say to me. You probably would say, well, you know, Dan, we got to think about how we are making new highs. And I have to tell you, for the last 3 days, the bodies of these candles, the bodies are getting smaller. And what we're seeing is we're seeing shadows, larger shadows at the highs. So for the last 3 days, they've been selling this stock. They're not buying it. They're getting out. They're not getting in. So then you'd probably say, I'll tell you what, why don't you wait? If you want to buy this, why don't you wait until we see evidence that buyers are coming into the market? So the very next candle, we see that big red candle. I say, should I buy it now? You say, well, I don't really see any strong evidence of buyers here. We have a little shadow on the bottom, but not real significant. The next candle occurs, and we have that larger shadow on the bottom, smaller body. Should I buy new highs of that one? Yeah, I might consider that, actually. We're seeing a change in behavior. The next candle after that, the same kind of thing. We're seeing that larger shadow on the lows. So would I be willing to buy a new high? Yes, because that shadow on the lows, to me, it says we're getting low enough to find some buying. And the last little guy, where we have a small body and we have shadows that are equal on both sides, well, that implies balance. That implies both buyers and sellers present. It's not dominated by either one. I mean, if it was, this red candle would have closed with a red body. That means we closed on the low. We don't see that. Buyers pushed it right back up. If it would have closed at the high, that would be a little green body. But we don't see that either. We see shadows on both sides because both buyers and sellers are present. Just a few candles ago, where we had that large red candle, we really didn't see much of that kind of action, I should say, or balance. There, it looked like sellers were pretty dominant throughout that whole candle. So what this implies is transition. It implies that something may be changing. So these are clues that you and I could look for to give us some feel for how the market may be unfolding. Now, let's talk about a strategy. And again, this is just one approach. It's something I find useful, and you want to take your time and look through it if you're interested in this, and see if it fits into the type of trades that you're doing. Well, first, we can utilize this with different time frames and different market conditions. It's a 3-candle reversal pattern is what I'd like to talk to you about. Trade entry, it's a determined amount above a bullish candle or a determined amount below the bearish candle, and I'll define what that is in just a minute. And by determined amount, let's talk about that. It depends on the level of the stock itself. In other words, is it a $10 stock, a $100 stock, a $200 stock? That'll have an impact on that. So that's why I don't have a specific number there, but I'll show you as we go through these how to calculate that. Now, it's typically profitable with the candle occurring after the reversal setup candle, so the next period of time. And that's something you'd want to verify. When is this trade profitable? If the pattern trade entry has not occurred, now this is where I'm using the time issue, within 3 periods of time, or it's not profitable within 3 periods of time after trade entry, consideration should be given to exit the position even though the trade risk management parameters have not been met. So my feeling is this trade should have a certain characteristic. It should perform within, in this case, 3 periods of time. And if it doesn't, I just soon give it the adios, big adios, and take that money and put it someplace else. So I'm looking for very specific behavior within a very specific amount of time. Trade profit management is a trailing stop, and we'll talk about that. It's determined, it's again that determined amount below the lows of the candles following the trade entry for a bullish pattern, or the determined or calculated amount above the highs of the candles following trade entry for a bearish pattern. Or trade exit could be a magnitude objective. So here's how you and I could calculate a magnitude objective. And it applies to really any approach that we could use, technical approach. let's say that we've looked at 30 trades using this particular setup. And let's say that the range of profit was $5 to $10. And what we could look at then is when I put the trade on, and if it's profitable, then that means the profitability will be someplace between $5 and $10. Now, we could look at the frequency of that profitability to give us an idea of what typically the profit expectation should be. But what we do know is that that would be the typical range of profit if indeed the trade is profitable. So from my point of view, a magnitude objective could be at 490. And I'm picking 490 because I wouldn't want to pick 5. It could kiss 5 and I don't get filled. But if I pick 490, I know it's got to trade through that price to get to that typical minimum profit, which is 5. So that could be a way that you and I could calculate a magnitude objective. And then the second half of our trade, we could now leave on to exit under normal conditions or at break even. So if we bought it at 50 and it trades up to 54.90 and we take half off, our stop move now moves up to 50. So on the second half of the trade, the worst we can do is not make any money, but we've locked in a profit that way. Now I call it lead up to rejection is the kind of pattern that we're going to talk about. And the lead up is the number of candles that make lower highs as we get to that candle. So here we have these candles unfolding. And look at the last one. See that larger shadow on the bottom in a small body, or there may be no body at all to the candle? I would call that a rejection pattern. And what I'm also looking at are 3 lower highs. So I see a rejection pattern. I count back. I got 1, 2, 3 lower highs. That means now my trade entry, if it moves above that candle, I now have a bullish bias, and I'm looking to be long this market. I could sell puts. I could buy calls. I could buy a vertical spread, bullish call spread, or a bullish put spread, right? I could do a back spread. I could use an option strategy that has a bullish bias that will make money if the market moves up. So those could be the strategies I look at. If I'm looking at buying a call, it goes back to the parameters that we talked about before. I want delta near 100. I want expiration beyond the current. And, those are expensive things, right, that I'm talking about, isn't it? I want delta near 100. Well, that costs me money to do that. And I want expiration beyond the current. Well, I'm buying time, and that costs me money. But here's the thing. If this trade doesn't work in the next 3 periods, I'm out. Unless the characteristics of the market that we're trading warrants additional time. So right now, if this doesn't perform in 3 periods, I'm out. So has time decay hurt me? Probably not. Price may have. I may not get exactly all my option premium back because maybe it's moved unfavorable to me price-wise. But I will be out. And I will now take that money and hold it and try to find another trade to put that at work in. And my stop, if price goes below that low, I don't want this position. Again, unless the way the market trades is unique in that it can move lower, then I'd want to know how much lower, and that may be my new parameter for exit. All right, so that means now you and I will be long. And what we could do is now move our sell stop below that candle, delete, get rid of the first one, and now just trail our stop. And that's all we're doing here now. As the market moves up, I'm moving my sell stop below the low of that candle. How much below that low is also a characteristic, a parameter that we'd want to calculate. And so in this case, it stopped us out, right? So that between the buy entry and the sell stop where we got stopped out, that would be the theoretical profit for this trade. So let's look at an example. You and I see on this candle chart here, we see that rejection candle at the low. Now we look above it and we've got 1, 2, 3 lower highs. Okay, so that's a lead up trade. And now we're going to buy, and that buy means initiate a long option strategy, whatever one we select, if price trades and makes new highs. And we could also set a parameter for that. If it makes a new high by 50 cents, $1, again, depending on the price of the stock. So there's our buy entry. We're going to exit. If price does move down, we're going to exit the position. And, okay, so now we're long. And in this case, the market made higher lows until it got right up here. There it made a lower low than the previous candle, and that means we would be exiting that position at that point. So here's another example. You see a rejection pattern at the low. Ooh, let me show you something else here too. If actually, hey Mark, is there a pencil I could use here or a pen? Because I don't think you can see the arrow if I move it around. Can you?
No, Dan, I'm sorry. Our platform does not have that capability.
Okay, no worries. Not a problem. Because here's all we'll have to think about. Look at that last candle with that large shadow on the bottom. That's a rejection pattern, right? But before we talk about that one, I just noticed it. Let's go back. And if you look at it 2 candles ago, the previous candle's a red candle. The previous candle to that, hey, look at that small red body and the big shadow on the bottom. That is a rejection pattern. And we got 3 lower highs. That high plus the other 2 previous candles are lower highs. That's a rejection pattern. So if the market would trade above that high by the amount that we specify, that would initiate a long position. Well, it didn't do that. So that would have been a setup, but nothing happened. All right, now we got the same thing again. And we could ask ourselves the same question. All right, here's the setup. And if the market trades new highs, it goes back to all those parameters that we just talked about. So I got 3 lower highs, all right. And in this case, if we would have initiated that long position, as the market traded higher, we would get out once it traded lower than the previous low. Now, here's what I'd like to also talk to you about. And that is that if it trades lower, how much lower? If you look up in this chart, it's about 6 or 7 candles in there. And it's the first lower low. Do you see that one? Your little small green candle. Then we have that big shadow on the bottom. Notice that one? Well, depending on where I put my stop below that low, I may or may not have been stopped out there. I call this incremental change. What you want to look at is how much lower did that market go from the previous low, and then it still moved up. We still had the shadow on the bottom. All right, and then look at the next candle. You have that little small green candle, little shadow on the bottom. Then look at the next one. That candle there, notice the low of that next candle with the small red body. The shadow went lower than that previous small green candle. The amount that it went lower, you and I could measure that. And what we'd find out if it was 40 cents, let's say, and the previous one was 70 cents, well, then maybe I should trail my stop at 80 cents, something that's outside that range of what I call incremental change. And that would have kept us in that trade a little bit longer. But the first lower low, that would have been an exit point. And let's look at another idea on the other side. This is the same concept, only this is bearish. Now we have a large shadow on the highs. We have 3 higher lows and the same setup. We now sell if the market makes a lower low, and we buy stop is at new highs, so we'd get out. In this case, we would have had trade entry. We're going to trail our stop. So as the market moves lower, we're trailing our stop, and there we would have been, stopped out of that trade. Just so you can see that completed picture. There we go. All right, and I clicked a little too fast. All right, so that would have been exit. So that's what we're looking for. And the amount of time that we'd be in the trade, that would be another parameter that we'd have to look at. So there is some homework involved with this. If you find this idea interesting, go back and look at some stocks that you're interested in and look at how they performed. Did this work? Maybe it didn't work for the stocks that you're looking at. If it did, then you want to start asking yourself those questions. Here's 3 higher lows. There's that rejection pattern. Okay, that means you and I are going to sell if indeed it goes lower. And our buy stop is at new highs. In this case, okay, now you and I are short. This started to move lower. Okay, so there was our buy exit that we saw there. Let me show you that again. Sorry about that. There. Right, so that rotated higher. You see that buy exit, and that would have been an exit for the position. Here's another example. Look at that rejection pattern, and we have 3 higher lows. That means everything's set up, and again, we're looking for a bearish strategy. Whatever option strategy that you and I want to look at. I have to tell you, for me, oftentimes in this situation, I'd be looking for just buying puts. I want delta near 100, expiration beyond the current, needs to perform within 3 periods, and in this case, it did perform. It happened to go lower. And here we have 3 lower highs, and look at that. We got a big rejection at the lows. Son of a gun. And again, the next trade, we would have entered that trade. Now, there's something else I wanted to point out to you, and it's what I call heat. One of the beautiful things about options that I absolutely love is that you and I can define risk. We know what that risk is going to be when we establish a position, and then we can determine whether or not that risk is acceptable. And that's the beauty of options. Also, I like to look at how much risk did I have to sit through in this position to get profitable. In other words, look at this the bottom candle here, where I have number 3 on it. See that one? All right, look at the very next green candle. That means I would now be long that market, right? So if I'm long calls, now look at the candle after that green candle. And if you notice, that shadow would have traded lower than the arrow that you see for number 3. So that means that trade actually traded against me. The trade that we had at the top, after that number 3 at the very top there, that red candle, the market started moving in our favor. It never traded against me. So in a profitable trade, does the trade ever trade against you, is another characteristic that you can look at. So if we look at here, this happens to be SPY, and just an example of a market that we could take a look at. Just let your eye float over this candle here, chart. And what you see here is if you start over, let's go down here, look at the bottom. It's hard to see them, they're tiny. But you see July and then you see August. If you look right above August, or actually if you look a couple candles before that, we have a small green body with a large shadow on top. All right? And we have 3 higher lows. That means you and I would be selling this, and it happened to be that big red candle. Then we have another rejection at the low. And if it trades above the high of that rejection candle at the low, which is in August, that means you and I would be exiting that short position, that bearish position, and maybe even considering going long. If we do, it's got to be profitable within the next 2 to 3 periods. Also, look at the middle of the chart. You see that large shadow on the bottom and small body? You have 3 lower highs. That's again our rejection pattern that we talked about. It's a lead-up rejection pattern. And if I bought or went long, if I bought calls, for example, a simple idea, went long, or if you and I could go back and say, in this market, when we look at the size of the move in these trades, they move, let's say, $10. Well, that may give us some parameters that we might want to think about if we want to do a vertical spread. If we know that this market has a tendency to move within a certain range of profitability, a vertical spread may be something we consider. Or, again, maybe we just do the outright with just a simple buying a call. If we were within 3 weeks to expiration, where I know data is working for me, I might want to consider selling some premium. So if I sold some puts after that big lead-up candle here at the low, that rejection candle, all it has to do is go sideways for the next 3 weeks. And since I have a lead-up setup, there's a chance that this market could move directionally for me. And in this case, it happened to do that. But there's risk involved when it comes to selling option premium, as you're aware of, and you want to take that into consideration when you're looking at those kind of strategies. Here's just another example. There's a few things that you and I could look at here, but let's just start to the left. I think that's the easiest place to begin. And if you look up here to the right, you'll see a green candle, a red candle, and a green candle at the very high. Again, that's a rejection candle. I have 3 higher lows, and so that would imply a change in market direction. If you go back, though, after the high green candle, if you can see that one, now that's right before after April, go back 2 candles prior to that. You'll see a small red body with a large shadow on top. Well, for that market, it didn't trade lower. That's also a rejection pattern. But the market never traded lower. It never would have been activated. A few periods later, the same setup again, and that one did break lower. I also wanted to point something else out to you. Well, you see in the middle of this chart, go over to the right now, and you see a larger shadow on the bottom of a green body candle. That's also 3 lower highs, a rejection pattern. But the thing that's interesting about this, if you notice the candles afterwards, within 3 candles, it started to be profitable. So it met that criteria that you and I were talking about here for our friend Mr. Apple. Okay, and those are the parameters that we were just talking about. All right, we have just a couple more here in Apple, but we're getting near the end, and I want to make sure we have some time to go over any questions that you might have. That was Bancorp, Citicorp, same kind of setup there or Citibank, that you and I could look at. This is just that web page that we're talking about. Oh, what I wanted to mention to you here is there's a free video. Start here where it says Start Here. Click on that, and what you see is me standing there talking about the techniques and the things, kind of what we just talked about, but it's also a part of what you're going to see in those videos. And it's a free video, takes about 3 minutes, and it covers 6 different sectors. Again, just to give you an idea of how someone's looking at the market. This is just a little bit about my background. I come from the floors in Chicago, and I have a chance to share ideas with institutional traders primarily around the globe. And I want to thank you for attending today. And is there anything else here that we should be going over, Mark?
Well, yeah, Dan, there is. I do have a few questions. We've got a few minutes left, so we'll take some questions from the audience here. One of the questions they're asking is, to begin with, how do you narrow down your list of stocks before getting into candle analysis? So, you've got a portfolio. How do you decide which ones that you want to focus on in order to study this candle analysis?
There's a couple of different ways of doing it, and it really goes back to what your own comfort level is. You may want to look at stocks that are, below $20, for example, or below $50, so you can do it by price. Is the place to begin as a filter. Most broker websites now have screeners that you can use to filter out characteristics of stocks that you might find interesting. Depending on that broker's ability to do that. Some of them have the ability to screen for hammers, for example, which is the lead up or the rejection pattern that we're talking about. Some of them have the ability to scan stocks that may meet some other criteria that you're looking for technically. And it could, again, be moving averages or whatever it is that you want to look at. And that screener could pull up possible candidates for you to look at. Again, I think the decision process, the analysis process remains the same, no matter what the technique is from my point of view. We can make variations depending on that stock itself, that price. But that's usually how I begin. I also have, I don't look for stocks that present challenges to me. I don't see a reason to do that. In other words, it may have a great technical setup, but if there's not much liquidity in the options, I'm not really that keen on it. Because what am I looking for? I'm looking for the ability to execute my trade. And why do I want the challenge of trying to work a position in and out when there are so many other choices that I can make that the liquidity is there? Very easy to get in and out. So it's another filter I look at as well, too.
Okay, Dan, thanks. Now, you were talking about 3 periods, and some of the slides looked like it was 15-minute increments. Some of it looked like they were hourly increments. Some of it looked like they were daily increments. How do you, number one, is that true? And number two, how do you differentiate? How do you decide? Are you looking at this in a shorter time frame or longer?
Well, I would say this. There's one thing that was missing. You're absolutely correct, 15, 60, daily, and weekly. I had those in there as well, too. I meant to talk about that, actually, as we are going through that. What determines the time frame you're looking at, for me, is how much time I have. If I'm in my office and I have time, I like looking at markets from a day trading point of view. If you have a full-time job, I strongly suggest that you forget about that idea. However, and I'd look at a daily or weekly chart. What determines the time frame you look at is the volatility of the market that you're trading. The more volatile it is during the day, well, there may be some intraday opportunities that you and I can take advantage of. So we got to look for that consistent volatility as well. So when we would look at that stock in this certain price range, we could say, all right, how much does it typically move in a day? Is there opportunity for me to take advantage of that? And unless there is, I wouldn't consider it. And again, I don't suggest that unless that you have the time to trade intraday. And I wanted to show different time periods to give you an idea of how this characteristic is fairly consistent in different markets and in different time frames. But I typically look at daily and weekly.
Okay, terrific. Well, speaking of time, we unfortunately happen to be out of it today, so I wanted to, Dan, certainly to thank you. The comments that were coming across the screen here, everybody loved the presentation. It's tremendous information that you gave, and as I said in the beginning of the webcast, we're very, very lucky to have you join us today. So, thank you for your time, and ladies and gentlemen, thank you for taking the time to join us today. I'm sorry that we weren't able to get all of your questions answered today. However, we will forward these to our investor services group and to Dan as well if he would take a look at these to help us out for them. we just want to make sure that everybody has a better understanding of options trading. So should you have any further questions, please reach out to our investor services desk at options@theocc.com, and they're certainly ready to help. And don't forget to follow us on Twitter at options_edu. And like us on Facebook, and please remember to take a moment to fill out the survey on the right side of your screen. It's very important, and it really helps us out here to determine the future course of OIC. Lastly, there were a number of you that asked for additional information about options trading. You can take a look at our Getting Started with Options section on our website, optionseducation.org. Take a look at that. And then, of course, make sure you check out our website to join us for our next webinar. Dan, thank you again so much. Ladies and gentlemen, thank you for attending, and we hope to see you all next time.